All right, so let's get started. We have a new camera angle today. I don't know why. It's bothering me. But anyway, let's get started. So my name is Mark Lamonica. I'm the product manager for Morningstar Premium, morningstar.com.au. I will be staring off in that direction out of force of habit for most of today. But we'll see if I can learn by the end, Will, right? Will is keeping things interesting. Today we're going to talk about international investing, but before we get into that, we have, of course, our housekeeping items. So number one, anything you hear today is general advice. I don't know anything about you, so I can't offer personal advice. The other thing is, I would love questions. So if you could ask questions, that would be great. We had lots of good questions on Tuesday, and it makes it more exciting for me, which, as I always say, is the whole point of this thing. So if you could ask some questions, that would be great. Let's get going. All right. International investing. Also, if anyone has any questions at any other time, you can email me at mark.lamonica1@morningstar.com. So that's my name on there. So just add a 1 and a Morningstar, and we are good to go. I have a note saying that I need to say, I don't know what that is, though. Okay, I'm going to add another disclaimer because of our Kiwi friends and their new regulations. But first, we have to figure out what it is. So anyway, we'll get started, and then we'll do the disclaimer a little bit later on. All right, why do we want to invest internationally? So we'll start out with a couple facts, and then we'll get into how you actually do it. So Australians, like everyone else, exhibits a lot of home bias. And what that basically means is that, like everyone else, people are more comfortable investing in things they know. So that's often local companies. So that's something we see a lot. But what happens if you are Australian and you only invest in Australia? Well, what we did is we took a index, as you can see, a global all-cap index. So we're talking all different size companies. And we looked at how it's actually allocated between different countries. So as you can see, the US dominates this index, so almost 65% is the US. You can read, obviously, the rest of the different countries in it. Australia makes up 2.31% of this index. So what that means is, of course, if you are only investing in Australia, you are missing out on 97%, more than 97% of the companies around the world. So by only investing at home, you're limiting the pool that you can actually pick to invest in. Other reasons that, well, we'll get to that in a second. Other reasons why home bias can be damaging to you as an investor is all of us are very exposed to the Australian economy. So either you have a job, you have real estate, you are exposed to the Australian economy, and by just investing in Australia, you are now doubly exposed to the Australian economy. So something to think about there. And then finally, let's look at some sectors. So we talked about how you were missing out on 97% of the world in terms of market capitalization. I looked at 2 different ETFs here. So this IWLD is an iShares holding. So that's the iShare Core MSCI World All Cap ETF, which basically tracks a global index. And I looked at the Vanguard Australian Shares ETF, which tracks, the ASX 200. And what I did is I put the sector allocations in each one of these. So as you can see, you're missing out on some pretty key sectors if you just invest in Australia, one of which, of course, is technology. So you can see that that technology makes up almost 17.5% of this global index, only a little above 3% in Australia. So you're missing out on technology. The other thing you're getting a lot of right here, basic materials. So those are the miners. So almost 18% in Australia. So you're way overweight miners. And obviously, if you're picking individual stocks, you can pick what you want. But even if you're just investing with an index fund or a local fund, Yeah, you're getting a lot of miners, you're getting a lot of financial services. So the banks here, 26%. So you can see that there are variations in the different types of companies that exist in different markets. So this index that we're looking at here, this IWLD, it is across 23 developed markets. There are 5,875 different constituents in this. And this is basically 99% of the developed market shares that are available for purchase. So this is a wide-ranging index, but you can see the differences in allocation between Australia and this index. All right, I have the disclosure now. If I don't read this, I'll get in trouble with compliance. So we're going to take a quick break to say, if you are in New Zealand, the views expressed in this presentation are of Morningstar and not any individual. Any advice is general in nature, and attendees should seek the advice of a financial advisor. They require tailored advice to their situation. And the New Zealand FAP disclosure statement is available on our website. Is that not how you pronounce that? FAP? Okay, that is available on our website. Okay, so sorry about that, but now we are all compliant. All right, let's look at individual shares here. So the peanut gallery is laughing at me and my pronunciation of that regulatory document. Let's look at allocation between different shares. So once again, on the left, we do have this MSCI, this iShares product, and then we have VAS. So what are you getting a lot of in Australia? As we talked about, there's huge concentration to banks, and miners, as you can see in the names on this list, as well as, of course, CSL. Over here on the left, what are you missing out on? You're missing out on some of these giant technology companies. And we've talked a lot about this. We talked about this in Is the Market Overvalued? We talked about this in the technology ones, but you are missing out on a lot of different companies that are certainly driving the economy. You can see many of them fall in that technology space or that communication space, which Facebook and Google are in. So you are missing out on a fair amount of companies. All right. Let's talk about investing overseas. So people always like this currency risk thing. We get lots of questions and comments, so hopefully we'll get that again today. All right, how does currency risk work? So how do you actually invest overseas? Well, there's a couple different options you can take. Number one, you can obviously pick, as I listed before, you can pick a global ETF or fund. The other thing that you can do is, of course, you can buy direct shares. So almost every broker now in Australia does offer the ability to trade internationally, at least in a couple markets, so generally the US and the UK. There are some brokers that actually offer this commission-free, and the way that they do that is they gouge you on the foreign exchange. And yes, I use the word gouge because that's what they do. So check and make sure that even for those free services that you are aware of what those fees are. But anyway, one of the big risks that you face investing overseas is currency risk. Now, currency risk will apply whether you are buying direct shares or whether you're invested in a fund or an ETF that invests overseas. So let's talk through currency risk, and we're using an example here. So we're going back to August 30th, 2014. And the reason I picked August 30th, 2014 is because that's the day I moved to Australia. So I'm trying to make this all about me. And when I first did this presentation, it was in June, and I haven't updated it, but Microsoft has just gone higher since then. So let's look at what happened if you wanted to invest. The day that I moved to Australia, you thought, okay, now that he's left the US economy is probably going to do a lot better. And so you want to purchase Microsoft. So you went in and you bought Microsoft. Per share, it was $45.43. And you're investing $10,000 Australian in this. So you buy 205 shares. The exchange rate that day was $1, so an Aussie dollar, equated to close to 94 US cents. So you're putting 10 grand Australian, you are getting $9,313 US of Microsoft. Then you sold this in June. So what has Microsoft done? Well, Microsoft has done very well. So Microsoft has gone from $45 up to $187. And that's great. So you've made lots of money. But what has also happened in this period? the Australian dollar and the US dollar exchange rate has changed. So now one Aussie dollar, or back in June, it's much higher now, but one Aussie dollar equals 68, that's USD, not UAD. I don't know what UAD is. I should make less typos. So what has happened to your investment? Well, from a US perspective, so value US dollars, your $9,313 investment has turned into $38,486. So that's really good. That's a 313% return. So you did really well. But you did even better from an Australian dollar perspective. Because when you're translating that 38,000 back to bring the money back into the country, it's now 56,574. So 465% higher. So very simply, what happens if you invest in an American company or any other company overseas, you get a higher return if the Aussie dollar gets weaker. So think about that from an investing standpoint. You always want the Aussie dollar to get weaker against whatever currency you're investing in. So you can see the impact of this where the Australian dollar got significantly weaker. 94 cents about down to 68 cents. Now we're up to like 77, 78 now. So the Aussie dollar's rallied a lot last year, but still, it just shows you that a weaker Aussie dollar is positive for you as a international investor. So now why do currencies move? There's all sorts of different reasons currencies move. A big one is interest rate differential. So of course, money is going to chase higher interest rates. So if you have higher interest rates in your country versus another country, you'll get inflows, and that's going to influence exchange rates. The other thing, particularly with the Aussie dollar, is that it is very related to generally resources. So iron ore prices, commodity prices, things like that, because it's obviously such a big export here. So currency risk is something that you need to worry about as a global investor. Now, what can you do about this? Well, you can buy a hedged product. And we've talked about this just because we get questions about it in different webinars. I can't speak. But a lot of funds and ETFs actually have hedged products. So you can see here is an example, and I can show you on the website later how to find them. And simply what a hedged product is they are going to remove that currency risk from the fund. So in this case, the fund is exactly the same. In all cases where they have a hedged product and an unhedged product, all of the underlying holdings are exactly the same. It's just they remove the currency risk, and they do it through generally derivatives. So they'll use currency forwards to remove the currency risk. So when you buy a hedged product, you will pay slightly more. Like they're generally very, very small amounts. So I think this Magellan, you are paying 0.06 versus 0.03 in transactional and operational costs. You're paying slightly more for the cost of those hedges. So you do pay slightly more, but given the giant swings in currency, it can certainly be worth it if you, of course, make the right decision. So you can see here, if we go back and we look at these two different products, you can see the differences in return. So this hedge product hasn't been around as much, but you can see certainly at the time that I pulled this out, look at year to date. So hedge, you were actually negative, whereas you were positive with the unhedged version. And you can see sort of on 1-year returns and 3-year returns and 5-year returns that there are differences in those two numbers. So that is one way that you can get rid of currency risk. It's really the only good way to get rid of it. You certainly don't want to do this. By yourself. All right, so let me show you where you can find hedged versus unhedged. So they're all in the name. Which makes things nice and easy. So I will share our website, which is being nice to me. It's saying, welcome, Mark. All right. So if you go and just look into any fund or ETF international category. So if I go, I'll do ETFs. All right, so basically this is going to generate a list of our medalist rated funds and ETFs. So these are funds and ETFs that have a gold, silver, bronze rating, meaning we think that they will outperform the market over a full market cycle. So yeah, simply go through and start reading the names. So C&H, what are these? This is the exact same ETF. So this is that ETF we were looking at as part of the presentation. This AUDH, Australian dollar hedged, that's that same fund or ETF. You see Vanguard has hedged versions as well. So yeah, it's pretty obvious from the names. You can just go through and read those if you actually want to hedge. Here's another example, hedged H. There we go. So easy enough. So that's how you can actually get a hedged product and remove that currency risk. Okay, so we've got a good question around this. So Lisa, who always asks questions, which is good, and we always talk about her alpacas, who are hopefully warmer now and have dried out now that the weather's gotten a little bit better. So she says getting your U.S. investment dollars back when selling carries a currency conversion fee by banks or brokers. Does this mean you factor this into your profit or loss? Yeah, it does. So depending upon what that currency conversion fee is. Now, you won't pay that, of course, if you are invested in a fund or ETF, but if you want to buy direct equities, yeah, you're going to have to pay money to exchange those your Australian dollars for wherever you're actually investing. And that is when you see all of these companies telling you that they will offer you free brokerage on international trades. That is where they are making all their money. I don't know why, but for some reason, people just assume that these companies are doing this out of, I don't know, their good nature to not charge you for this stuff. But that is where you're actually going to pay the fee. So go in there and look at what those fees are, because they can be pretty significant. So like IG Markets offers free trade, Stake, I'm sure others as well. But yeah, go look at those fees and think about what they're doing with domestic trading as well. Most of them, like Robinhood, we always hear about Robinhood in the US, they literally sell your data to hedge funds so they can front run you. And so you're just paying that cost in your bid-ask spread or your buy-sell spread, which is how people say it here in Australia. All right, so we've got a question from Vidania. So she just says, or maybe just more of a comment. So she's saying it's interesting that and she was referring back to that slide when we were looking at the sector allocation for different for the U.S. versus Australia. So there's two different ETFs looking at healthcare and saying interesting that about the same percentage of those two ETFs are in healthcare, around 13%. She says, any comments? The only comment I would make is if you look at Australia, yeah, it's about 13% healthcare. Half of that is CSL. So that's, I guess, my only comment about healthcare is that it's very dominated by one company, which is obviously one of the largest components here in Australia. All right, so we've got a question from Peter. So Peter's saying, do you follow any reverse type funds or ETFs? No, we don't. So basically a reverse type fund or ETF is, some of them are called bear market funds, bear market ETFs. So they move inversely to the market. Market goes up, they go down. Market goes down, they go up. But we do not cover those. We've got a piece, the head of our editorial team is working on a piece, which I read last night, around looking at different types of ETFs. So particularly looking around these thematic ETFs. And she talks about in there why we don't cover them. We don't think they're very good most of the time for investors. And also the problem, of course, is when you are invested in any of these reverse type funds or ETFs, just like shorting a stock, think about it, like your losses are unlimited and there's a set amount of upside on the gain. And so it's the opposite if you're an investor, right? The only thing I can lose as an investor is all my money. But I can continue to gain, so I can lose 100%, but I can gain thousands and thousands and thousands of percent on my money if it keeps going up. Same thing with those, but in the opposite direction, right? You can just lose and lose and lose and lose. So just something to think about. All right, we're going to go through a couple more resources we have for international investing. That is the wrong screen. I blame that on the camera. And mostly you will. You know, last Thursday, we went out for drinks with Will and everything was great. And then he pulls this camera trick. All right. So if you are interested in looking for international investments, there are a couple different places you can look on our website. So number one is stocks, of course. So there's a couple different things you can do. So we do have Global Equity Best Ideas. So this is one of our most popular features. So this gets published every month on the first of the month. So we'll have a new one coming out on April Fool's Day. So you can see there are 72 results in this March 1st one. And basically the top is Australia because we're in alphabetical order. But you can see our top picks by our analysts all across different markets around the world. I won't keep scrolling down, but you get the point. So that's one place you can look. The other thing is you can see our top rated stocks in a lot of different markets just by sort of scrolling and looking at the different cards. So got Aussies, Asian stocks, European stocks, etc. So you can see that, and you of course get access to all 1,600 of the global companies that we cover here at Morningstar. Your other options, I said, of course, are funds and ETFs, and you can go in these same sections. So Medalist Global Equity, so those are funds. Those are ETFs, so that's an option. And then we've combined it all in this thematic investing, income, sustainable. There we go, global investing. So you can go through and see some of these different ways that you can access international markets. The other thing that you can do, of course, is you can type anything you want into the ticker, but you can also go through and filter yourself. So for both stock filters, you can see here, pick your market, funds and ETFs. You can also pick global equity, global property, etc. So there's a lot of different ways you can discover new investment opportunities overseas. The last couple things I will show you is how much should you invest overseas is always a question that we get. Going to track investments and asset allocation models. You can see that we have 5 different models here based on different risk and return criteria that people have. So we scroll over, we'll use aggressive as an example, and you can see that we recommend 45% for our aggressive portfolio in international equity, and you can see 50% hedged. That's my boss. I'll watch out for him. So you can see, you can see also international listed property, etc. And then finally, we've got a guide for international investing. So if you go into Learn to Invest, we have, where is this thing? The Morningstar Guide to International Investing. So a lot of the different concepts that I talked about today, you can go through and read about them in this guide that I wrote at some point in 2019. So yeah, you can go look at that guide. All right, we are not getting many questions today. Should I read that New Zealand disclaimer again? Or is this going to be the world's shortest webinar? Will went through all this trouble to put the webinar or to put the camera on the table. All right. Well, this might be the world's shortest webinar. So if anyone has any questions, feel free to send them directly to my email. Send them. Send it through. Send it through to my email if you have any questions, and I will get back to you. All right. Thank you guys very much. I appreciate it. That's not going to end it. This is going to end it.
Any advice in this video is general advice prepared by Morningstar without reference to your financial objectives, situation, or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest.